Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to use. So, how should you view the Supreme Court ruling on tariffs, and how should you invest? Also, AI is still rattling the markets, and a look at investing in the private credit market. It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Kerry Coghill of Coghill Investment Strategies, also Frank Rossetti. Frank has his own alternative investment company, HF Management Company. Also sitting at the table is Kim Forrest of Boca Capital Partners, and also seated is Michael Godwin he's the Chief Investment Officer for Fragasso Financial Advisors. Thank you all for joining us once again for The Bull, the Bear, and You. First, a quick look at the markets and what has happened since the last time we met about 2 weeks ago. It doesn't take long to see that the major indices have all slipped. The S&P 500 has been bouncing off its 100-day moving average. In fact, the NASDAQ and the S&P 500, as of the close on Monday, February 23rd, were both down for the year. Just a little tiny bit, but they were both down for the year. Now, we have had unemployment numbers, housing numbers, consumer sentiment numbers, and GDP numbers, but those numbers apparently will pale with the impact of a Supreme Court decision on the stock market, what that decision will have on the stock market, and the speculation as to what the future holds not only for tariffs, but also for going forward with AI. The Supreme Court did not rule anything on the AI, by the way. But Kerry, the basic question I have is, what is the impact of an investor in any town in this country about the Supreme Court ruling on tariffs, or is there any impact at all?
Well, it's interesting because we do have a framework for this. We can go back last year and look at when Liberation Day happened and all of these tariffs came to pass, and then they were pulled back, and then some of them were enacted across the board. And what we learned from last year's tariff episodes is that for investors that stay focused on their goals and understand a buy and hold approach, this lack of clarity with the tariff situation is probably going to continue. And those investors last year that understand their risk tolerance, understand their asset allocation, and waited out the wild ride that we had in early last year, benefited from a market year that was up. So I think to answer your question about does this tariff situation have a direct impact or will have a direct impact, particularly on investors, it will from a volatility perspective. But as an investor, you have to stay focused on your own risk tolerance, your own allocation, and the fundamentals of what's driving the market.
That being said, the tariff issue, from what Kerry's trying to say, is that the market activity will probably be short-term volatility, but over the long term, it shouldn't mean much. Corporations run themselves to be profitable over time, and they will adjust to whatever twists and turns happen in the tariff world, because it is twisting and turning as we speak.
I think I'm not going to opine whether right or wrong, but President Trump certainly believes that the U.S. is getting a raw deal on trade. So tariffs will be implemented one way or the other, whether it's 10%, 15%. He'll find latitude to do something almost across the board. You're kind of seeing that play out right now. To Kerry's point, companies really are struggling to get clarity on what that means and how much it will be. Will they be able to claw back any of the money they lost from tariffs? All that's yet to be determined. So I guess I agree with Kerry in terms of the volatility in the markets will be persistent surrounding that. But I find it hard to believe that most companies are worried about other concerns or threats, particularly regarding AI, than they are maybe even about tariffs, particularly like the larger publicly traded companies here. So again, I don't want to say that the tariffs are a non-trading issue, a non-market issue. I mean, they are, but we've already seen sort of like the peak in regards to uncertainty regarding tariffs, and that's more or less dissipating, I think, as we go forward.
You know, Stacey, it's interesting because with tariffs being enacted, we have seen tariffs enacted over the last year. If you look at the year over year, you know, GDP growth, inflation data, the numbers look good. So whatever has transpired already, it really hasn't had a negative impact on the economy directly in terms of these numbers. You know, there obviously are concerns with unemployment and so forth that may be brewing. And as far as, you know, when and where we're going to get clarity, expecting clarity, like don't expect clarity, because the act in which the president has now been enacting these across the board tariffs only allows for tariffs for, I think it's 150 days. So something else it has to give. And then these questions about companies getting rebated and even consumers being rebated, that's probably, if it goes, that's probably going to be in courts for years. So it really lends itself to stay focused on the fundamentals and understand that we're going to have added volatility.
I was going to bring that up, whether I think it was, I can't remember which company filed yesterday saying they want their money back on
Yeah.
the tariffs. But I think you're probably right. It's going to take years before that's all taken care of in the courts.
Right.
It's an interesting equation. The company wants the money back. I wonder how much of those tariffs have passed on to the consumer.
Absolutely.
I mean, I'm not so sure that the company should be getting the money back. It could be that, I mean, to me, the simple way to do it is just send every taxpayer their share of the 133 million or whatever the number is, and be done with it.
Well, I think what you could see, and I have no idea if it's true or not, but let's just say company A is successful in its lawsuit to get money back on the tariffs they said they paid, and then you're going to have probably a class action lawsuit on behalf of the American people against those companies saying, we want our money that you charged us extra for. Because I have this sneaky suspicion that prices went up because of the tariffs, according to these companies. Are they going to come back down?
Well, of course
Because the
not.
tariffs...
The margins are going to grow. That's good for the stock market.
Yeah, exactly. I have a feeling those aren't going to come back down. We apparently have lost Kim. I'm going to hope that she comes. Hope that she comes back in. There was another thing that moved the markets on Monday, and that was a report by Citrini Research. And according to the Wall Street Journal, it tapped into new strain of fears about AI painting a dark portrait of a future in which technology change inspires a race to the bottom in white-collar knowledge work. And it says the new broader question is, what if AI is so bullish for the economy that it is actually bearish? You guys have any comment on that?
I mean, this is disruption, right? This is no different than, you know, I shouldn't say it's no different, but we've had disruption, you know, for centuries, right? You have the Industrial Revolution, you have, you know, the internet, right? Remember when the internet was invented?
Yeah.
I mean, we were there for that. The cell phone, so many different disruptions economically that, you know, we say this time and time again, when you have this kind of disruption, the careers of tomorrow haven't even been invented yet. So yes, there will be jobs, there will be functions that aren't needed anymore, but it will open the door for other types of career paths and, you know, degree programs and everything else. So I think that you really have to take a balanced approach when you're looking at this. Yes, there are negatives, but there also are positives and opportunities.
I will say one thing relative to what the computers are doing with AI. It's going to change everything, as Carrie says, but it is not going to deal with the human condition. People are in the equation. People do not respond to things as you might expect, far more often than you might expect. And consequently, humans are going to have to interface between this technology and the ultimate customer, which are people. And to get the message across, And that's not going to be something that's going to be able to be done by algorithm, I don't think.
All right.
Yeah, I don't know. I read through that report. It was kind of long but interesting. I'm not sure it's as simplistic as we're making it out to be.
Okay.
I do. This is if it all plays out. I mean, it is certainly a concern, right? I mean, what AI is doing is it's displacing something that technology has never really displaced before, as Frank mentioned. The human ability to think and reason and be smart. I mean, AI is certainly becoming much smarter than what people are able to do, and able to do things that people can't do much quicker than we have been able to obviously do in years past. And so I think that's a big concern. And then as it begins to, on a scale where, the worst case scenario where it displaces a bunch of just white collar workers who are the biggest portion of consumer spending in the country by far, that just kind of exacerbates the problem, and it becomes sort of a vicious cycle for the most part. But I think for that Citrini report and kind of everything that the bears kind of say about this, I think Bill Gates once said that we always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10 years. So to Kerry's point, I think this is something that is a concern of mine, but there's a million cogs in the wheel that are a concern of mine also.
Kim was able to rejoin us. Kim, we've been talking about this report that came out on Monday that apparently helped move the markets by Citrini Research, and the Wall Street Journal had an article on it, and I'll just take the last quote I used, which is, the new broader question is, what if AI is so bullish for the economy that it is actually bearish?
Oh my God. I'm so glad I got to log back in, and I'm so glad my computer cut me out. So this is what we're talking about is, let's let the machines run things, and then we'll just sit around and have a Jetson kind of life. I'm not falling for it for many reasons. A, because, I have very little running on my PC. It's a newer PC, and it just does things, right? We have all been where I am sitting right now, where technology does things for unknown reasons. I don't want it to do things like surgery on me without having a surgeon next to it. I don't want it flying a plane. I don't really want it driving a car. But here's why. I used to work in software. I specifically worked in AI. And I think we are at peak hype cycle now, because the AI companies are fighting each other. They need to demonstrate this AGI, artificial general intelligence, where the computer really does understand things and can completely do something 100% correctly. We are not there. We are so far from there, it's not even funny. But guess what? We are in a fundraising. Those companies that are designing this are out there in the public asking for more money. So of course they're going to come out with these things like, well, we'll never have to work anymore, and don't worry about it, because they are talking their own book. I hate to be overly pessimistic, but I agree with Bill Gates on this, that what they think is going to happen in the next couple of years, and even what they think is going to happen in the next 10 years, is going to be dramatically different than what people believe now. And all the panic, all the selling, all the hand-wringing that's going on right now. I hope I'm making myself clear, too, because I love AI. I think AI can do some marvelous things. But what these companies, Anthropic and OpenAI in particular, are, and they're the biggest fundraisers, just remember that at this time, they are straight up telling the very best versions of themselves, and they're lying about things, saying that the problems that fundamentally exist in the math and the basic compute of these systems can be overcome by more money, and they cannot.
All right, so this raises the question, and maybe none of you want to answer it, I don't know, but given what Kim says, if Kim is correct, do you invest in these companies then, if she is correct in what she's saying?
That's the world I'm in. These companies mostly are private companies. Anthropic is not public.
Okay.
They just did a fundraising dog and pony show out in San Francisco a couple of weeks ago. They picked up some number of millions or billions of dollars. I think it was 16 billion. I can't remember. These numbers are astronomical to me, to expand their product Quad, and that's all well and good. But you can't invest in it. If you own it, you can't sell it. If you want it, you can't buy it. And that's the world I'm in. And when Anthropic today announced that the Chinese are stealing their data to make their products happen faster, this is a very, very dynamic situation going on, possibly explosive situation that's going on. And it's going to be interesting to watch. But when Wall Street starts coming to everyday people in their 401ks for money, I get nervous.
All right.
So I just want to add one. This is kind of a public service announcement, but it's really designed to get people thinking outside of the box, because with everything that AI can do, and Michael was talking about this, there's a human connection that AI cannot duplicate, and human emotion and feelings. So if we're looking at industries that will benefit from the growth of, AI, I would look to the mental health industry, because for our children and our grandchildren to maneuver through, like we're in business and we're so focused on business, but how does this affect education? How does this affect how our kids are taught in school? How does this impact their social interaction? And to me, there's a whole industry here that hasn't even been developed in terms of how you take those positives of AI and create a framework for future generations that is much brighter and more productive and more enriching than what we had. So a little bit of a PSA there.
Kids won't go to school anymore. Everybody's going to have their own private tutor that's backed by AI. There will be no more schooling in 10 or 15 years.
But I think parents care, right?
No, I said that tongue in cheek. I'm joking.
And I know that. But that, the learning element of it may be very much automated. But then where's the social? Like what?
Yeah.
Like there's so much there. To me, I look at it as opportunity to, how do you enhance a person's life through this and enhance their social interactions, because we know social interaction is important. So what kind of platforms can be created, for our kids to be able to, kind of have the best of all worlds?
Well, except this weekend I read somewhere that there's a study that was done on the benefits, supposedly, of technology being used in education. And scores are going down. So it seems, and it's probably too early to be certain, the technology is actually hurting education, as opposed to having people read actually books with paper and talk to teachers that are standing there so that they can question them and they can probe. And that may be a better way to educate than via the way we're talking to people right now and via technology.
And I know we've gone off on a tangent here. But if you do brain scans of people that actually write a letter versus put it into AI, you can see the decreased brain activity still.
Well, I don't doubt that. I will say this, if I can interject as well, and I think this is kind of what you're getting at, and that is, I believe it is, it's not Anthropic, it's the other one. ChatGPT or whatever it's called. They let some people go who were opposed to ChatGPT coming up with a system to allow people to. It's not necessarily pornography, but adult conversations with a bot, and we go from there to. My son works in the mental health field in Nashville. And he just expressed the other day that, some people are trying to record their sessions. And if these sessions are recorded, some company is going to take this and then try to use a bot to help people with mental health. And Kerry, I think this is where you're coming from. His contention is that you cannot eliminate that interaction between two humans in dealing with this.
Right.
But this will be coming, and people will use it.
Can,
Yep.
can I interject something here? What we're talking about not is that technology exists, but how we're going to use it. And I think in every single innovation, there's been, the Luddites, of kind of which I am one, right? I'm a late adopter, even though I designed the software at some point, but it has to be appropriate for life. And right now, it's just such this fleeting frenzy. And again, follow the Benjamins. A lot of this discourse is being caused by the companies developing it, trying to give it a rosy hue and making people want to buy in, and fund them. So consider that. But how this is going to shake out is going to look completely different than what especially the companies are kind of proffering as their way forward.
Okay, I'll try to go back to script here, the things that we said we would might talk about here. Let me move on to this one. I don't know how, and this probably comes in Frank's wheelhouse again. I don't know how popular investing in the private credit market is with your clients, but according to Bloomberg, there are now some red flags waving. Investors have been pulling money out of some of these funds, mainly over lending standards and the disruptive power of AI. One asset manager is quoted as saying, quote, "The red flags we are seeing in private credit today are strikingly similar to those of 2007, end quote. Now, the average person, of course, is not invested in these markets, but for me, the problem comes with the push to allow investing in this kind of market for people who have 401ks. Any comments?
Well, let me say that there are all sorts of ways to invest in private equity. I mean, business development corporations have been doing it my entire career. And they trade publicly, and you can buy them on stocks and on the stock markets, and they typically sport enormous dividends. And but their stocks tend to be volatile in times of trouble. If this AI splurge and all these hundreds of billions, if not trillions of dollars that are going to be borrowed to expand all this stuff, before there's really a monetized use for all this stuff they're building, there's going to be some failures. And what these articles that are coming out today, likening this to 2007 and 2008, is all the layers of debt that gets piled on each other. And somewhere down the road, there's going to be I forget what it's called, but there's going to be a problem at some point, and it's going to be like dominoes and fly through the debt markets and cause trouble. I don't know that this problem is that big. I don't know that it's not that big. It is a concern for me in the illiquid markets, the way I am, because you can't get out. There's just no way to reduce your exposure. And that's why normal people shouldn't be here. If you can't ride it out, or my clients can ride it out with the money I'm working for there, all right? And so, I mean, I was very careful to make sure that people understood that things like this, I couldn't predict what they would be, but things like this would happen in all of our investments, making us wonder why we made it at some point in time. And if that has happened, and it will continue to happen, and that's the nature of the beast, but it has to be done by big boys, as you say.
So we've been investing in private credit since 2020 or 2021. We still like the asset class longer term. I think you need to be right sized, make sure that it's not a large portion of your clients' portfolios, which is what we've been doing for the better part of 6 years or so. As Frank mentioned, it's not a liquid asset class, meaning you can't get out of it. You can't buy today and get out of it tomorrow. But it's very, very akin to just a high yield bond market. And there's many, many similarities to that, which has been an asset class that retail investors have been investing in since the 1980s or so. There will be periods where the markets underperform due to spread widening and due to certain companies, defaulting. These are essentially junk type bonds with junk type credit ratings. But over the long haul, we still think it's a very valuable asset class. But you really, really need to do your due diligence on who you're investing with, who you're partnering with here. I'm a little bit biased, but that's kind of what I do for a living. I mean, we spend an inordinate amount of time kind of researching the companies that we want to partner with here, and we still like the asset class longer term. Will there be hiccups? Will it underperform just the investment grade bond market? Sure, but I think if you extend your time horizon 5, 10 plus years or so, you could get significant amounts of returns. You just need to make sure you're properly diversified. Jamie Dimon talks about cockroaches there, or he said a couple players doing some dumb things. 100%, you're going to start seeing that across the board, but you make sure that you're invested appropriately with the appropriate managers who've been doing this for decades. I think it can be a viable asset class to diversify somebody's portfolio.
And the operative words that Mike said is that you're talking about 5, 10, maybe more years. Most investors cannot think that way. They have to buy a car and need to sell something, or they're going to move, or their kid goes to college, and they're going to need to turn things into cash. And their assets are limited enough that they can't, if they have to sell what's liquid, they may end up being overweighted in these assets because they can't sell them, and that would be a mistake to do. And I'm sure, Mike, in your work, you make sure you don't let that happen.
Well, my approach to private credit is very different. We do not own any private investments, so I'm glad that Michael and Frank, they're the experts in this field. But the reason why our firm has chosen not to own private investments really has to do with our clientele. Our clientele are mainly individuals and families who are relying on a stream of income now and into the future. I don't have the ability to model private investments. I can't say, oh, when inflation does this or the economy does that, I can model it out. And if I can't model it out for a client, then we're not using it. The one area of the market that I am negative on and pessimistic on is private credit. And the reason why is that in the private world, not necessarily the publicly traded, but to Frank's point, there are layers of debt here. So even if you don't own private credit, if it starts to unravel, we will all feel the impact of that. Because when you use leverage and you borrow money and things start to unravel, you get what are called margin calls, where you have to sell something in order to meet that margin call. What are you selling? I don't know, maybe the Verizons, the AT&Ts, the Johnson & Johnsons, the good stuff. So there's a lot of layers to this. And this is very much, when Jamie Dimon, I think it was Jamie Dimon that said, someone said recently, it has feelings of 2008. There definitely are similarities, different, but similar, right? So the question is, and I don't think this is an imminent issue, and neither was 2008, by the way. It started much earlier than 2008. So the big question is, what do investors do? And what investors do is they make sure that they have the time frame, right? You can't get out of the market. I know people that sold going in 2008 that never got back in, because there's never a sign to say now's the time to get back in. So you have to really manage your risk tolerance, manage your asset allocation. During 2008, if you had a well-diversified portfolio, asset allocation 60-40, 50-50, whatever the case may be, it took about 2 years to recover. Most people that are investors, their time frame is longer than 2 years. The big question is, can you live through it without selling? So I think now is a great time to be revisiting your asset allocation and really understanding, okay, this can happen. And if it does happen, am I okay with riding it out? So, that's it's something that we are watching very, very closely.
Okay, Kim, any comments at all before we wrap it up?
I do, and I'm going to keep this brief. Firstly, I think this really speaks to why if you're doing it yourself, you really should consider looping in some sort of advisor, because these are people that are paid to look at these asset classes and understand them profoundly. I think this is also good to see that, yes, there are many different ways you can use this or not use this. My overall take on private is this, that it gets a lot of press and it's a little on the faddish side. And whenever like Harvard has a really great year, and most of these pensions and foundations use a whole lot of private, they have venture capital, they have private real estate, they have private debt, they have lots of moving parts there. And guess what? One time, every year somebody's going to be the winner. If you're just a do-it-yourselfer, liquidity is valuable. And that's all I have to say about that. But if you want to explore more exotic kinds of vehicles, I recommend that you talk to an advisor, because these are dangerous things in the wrong hands. And too much, too little, it's not going to benefit you.
It really does come down to for some clients, it's a good fit, and how much money you have matters, and how well you can diversify matters, but if that's something that you're doing, someone like Michael, like that's what he does. And most important is management, right? How good are they at what they do? So, it is a part of the market, and for institutional investors especially, it's a big part of what they do. And for some private investors, same thing. But to Kim's point, make sure you're aligned with someone that has expertise in the area.
Any final comments, Michael?
No, I mean, Kim and Carrie hit the nail on the head. I mean, this is something that if it fits for you, then great. We can talk through all the risks and all that kind of stuff. Kim mentioned liquidity. I personally think liquidity is for a lot of people, is a very overrated topic. I don't think most people need access to all of their portfolio at any given 30, 60, 90-day period. You typically plan for huge liquidity events. With your financial advisor or down the line there. So, quote unquote, locking up some of your capital to not only maybe enhance diversification, but potentially enhance returns in some of the private credit, private infrastructure, private real estate markets could be a good way to, again, further diversify your portfolio, maybe add some returns there. But again, it's very, very dependent on who you are as an individual, a client for us, what your financial goals are, your needs are, all that stuff. So, it's very dependent on what your risk tolerance is and all that stuff.
Great. All right. Thanks so much for joining us again. We'll continue our look at investing in the economy in future editions. And since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. Right now, thanks for joining us again. We'll see you again for the next edition of The Bull, the Bear, and You.